Let's look first of our video, and then we'll come back to this topic again. So let's watch the video. Make sure that the sound is on. Yeah.
So what's the
Okay.
So what's the real difference between a truly great investor and someone who's just kind of getting lucky? Well, it all comes down to a skill called financial analysis. Today, we're going to break down exactly how to look under the hood of a company and make smart decisions based on solid evidence, not just the latest hype.
And that quote just nails it, right? It really is the core idea. Every single great investment decision is built on a rock-solid understanding of the numbers. If you don't have that, you're basically flying a plane in a storm with no instruments.
So let's get right to it. Why do we always start with the numbers? Because look, a company's story can be super exciting, but its financial statements, that's where you find the cold, hard truth. And this explainer is going to be your guide to reading that truth and seeing what a company's health is really like.
And let's be super clear about this. The distinction here is absolutely crucial. An informed investment is based on the evidence you uncover in the financials. Without that evidence, you're not really investing at all. You're just gambling on which way a stock price will go. And, that is not a great strategy for building long-term wealth.
Okay, so let's pop the hood and get into the actual toolkit. At the very heart of all financial analysis, there are 3 key documents. And trust me, if you're serious about this, getting to know these is completely non-negotiable. All this stuff, it really boils down to 2 simple but incredibly powerful ideas. First, what a company owns, its assets, has to equal what it owes, its liabilities, plus the owner's stake, which is the equity. And second, its income is just its revenue minus its expenses. These aren't just boring formulas. They're the fundamental laws of the business universe that tie everything together. First up, we've got the income statement. I like to think of this as the company's report card over a period of time, like a quarter or a whole year. It answers the most fundamental question: is this company actually making any money? What we're looking for is revenue that's heading up, strong profit margins, and of course, steady and reliable earnings. Next is the balance sheet. Now, if the income statement is like a movie of the company's performance, the balance sheet is just a single photograph. It's a snapshot on one specific day of everything the company owns and everything it owes. And the difference between those two? That's the shareholders' equity. And when we look at that snapshot, we're basically checking the company's vital signs. The debt-to-equity ratio, for example, tells us how much risk they're taking on. Liquidity ratios tell us if they can pay their bills tomorrow. We're also looking at how fast they're selling their inventory and collecting cash from customers. All of this paints a really clear picture of how efficiently the company is being run day to day.
But let's be real. How do you make sense of all this data without your eyes glazing over? Well, this is where visual tools become an absolute game changer. Instead of getting buried in a spreadsheet, a chart like this one can show you instantly how a company stacks up against its competition on the most important metrics. It turns a sea of data into a story you can understand at a glance.
And finally, we have the cash flow statement. Now this might just be the most important of them all. I like to call it the ultimate reality check. Why? Because accounting rules can sometimes make a company look profitable on paper, but this statement shows you if actual real cash is coming in the door. A profitable company that's burning through cash, that is a huge, huge red flag.
So, we've got the 3 core statements down. Now let's level up. We're going to see how all of this builds into more powerful metrics that can really help you separate a good company from a truly great one. Let's look at 2 really powerful metrics. First, there's return on invested capital, or ROIC. This tells you how good a company is at making money from the capital it already has. Think of it as a measure of its current strength. Then you've got return on funding, or ROF. This one is more about the future. It measures how effectively the company is using new money to create even more growth.
And here's a perfect example of why this is so important. Amazon's return on funding actually tripled in just 3 years. Now, for an investor, that was a massive signal. It showed that even as a giant company, Amazon was getting better and better, more efficient at turning new investments into growth. That's a powerful sign of a company that's built to last.
But of course, no single metric can ever tell you the whole story. And that's why comparing a company against its peers across a whole bunch of ratios is so critical. A number by itself is just a number.
But a number in context? Well, that's information. This is how you see where a company really shines or where it's falling behind.
Okay, so we've analyzed the company's health. We've checked its efficiency. Now for the million-dollar question, literally, what is it actually worth? This is valuation, and this is where we connect all of our analysis back to the current stock price.
There are really two main ways to think about this. The first is relative valuation. This is kind of like pricing your house by looking at what similar houses on your street just sold for. The other is intrinsic valuation. This is more like calculating your house's value based on all the potential rental income it could generate over its entire lifetime. Both methods are super useful.
Now, you've probably heard of the PE ratio, right? It's the most famous relative metric, and it's a good starting point for comparing a company to its peers. But, and this is a big but, you have to be careful. A low PE could mean a stock is a fantastic bargain, or it could mean the market thinks there's trouble on the horizon. It always needs more context.
For figuring out that intrinsic value, the gold standard is the discounted cash flow model, or DCF. It sounds a little more complex, but the idea behind it is pretty simple. You try to estimate all the cash a company is going to generate in the future, and then you calculate what all that future cash is worth in today's money. It's a disciplined approach that the best investors in the world rely on.
All right, we have covered a ton of ground: the statements, the metrics, and valuation. So let's put it all together into an actionable checklist you can actually use when you're doing your own research.
So here's a roadmap that works. Step 1, start by screening for companies that even look interesting to you. Step 2, do the foundational work. Dig deep into those 3 core statements we talked about. 3, cross-reference key metrics like ROIC and ROF to see how the company really stacks up. 4, run your valuation models to see if the price makes sense. And finally, number 5, and please don't skip this one, document everything. It builds discipline and it makes your own thinking crystal clear.
And that brings us to what might be the most crucial point of all. These modern platforms, they give us incredible analytical power, but they are tools, not answers. The final conviction, the decision to invest, that has to come from you. It comes from your own judgment and your own understanding of the story these numbers are telling.
You see, in the end, the financial fundamentals, they don't lie. They cut through all the hype and they reveal the reality of a business. Every number, every ratio, every statement, it's all part of a bigger story. The only question left is, are you ready to listen?
Okay, let's dig a bit more on this topic. And if you allow me, I'd like to recall what kind of financial information we need by and by what we mean by balance sheet and income statement and so on, by looking into one of the slides we have here. And the most important thing, of course, is to distinguish between the income statement, which is here and on the low side, and the balance sheet. Balance sheet is really a picture of the company, how it looks right now, and the income statement tells us how the company made its money in a given period, usually a quarter or a year. So that's important. So the first thing to remember about the balance sheet, it's really very, very simple. Well, by the way, how you come to these statements? Of course, accountants need to register all the transactions the company is involved, and in what's called the journal, and then that information is aggregated in terms of assets and liabilities, and then the difference is, of course, the net asset value, or what we call here equity. So this is the fundamental identity in accounting. Assets minus liabilities are equal to the net worth of the company. And of course, the owners of the company, the shareholders, own the net worth. Okay, but of course, in the net worth, there is a portion of that is generated from, or that is obtained from the income statement, which is the net income, or the profit, as usually some people call. And that is, of course, the difference between revenue and expenses, revenue and the gains, expenses and losses together, and the difference gives us the the income. And of course, any net change, any change in assets and liabilities and equity must be equal to changes in assets. So that's the basics of. So this is all you need to know really about accounting in a certain sense. But of course, you need to probably want to dig a little bit more than just taking these very aggregate measures of a company or how to look at a company. And so we can, for instance, look at another. I should have it here somewhere. Yeah, okay. So in this table, which I call a cheat sheet on accounting, you have here the assets that you can disaggregate into current and non-current assets. And then furthermore, you can disaggregate them into cash and equivalents. You can disaggregate them into inventory and receivables. And of course, each one of these categories can be further disaggregated. In fact, a company, if you look at their accounts, they have thousands of, can have hundreds of thousands of accounts, which are in the end are all simple disaggregations of these same categories. And likewise, in the liability, you can have non-interest bearing liabilities and you can have interest bearing liabilities, which are traditionally debt from banks and other financial institutions, and the first traditionally debts from suppliers and so on. And the difference, of course, is equity. And equity includes both the carried equity that comes from previous periods and the net income, who corresponds to the increase. If it's a loss, it will be a decrease coming from the current period. And on the balance sheet, you have, in the income statement, you have on expenses, you can also disaggregate them into operating costs, interest expense, and provision for taxes. Likewise, in the revenue and gains, you can split them into net sales, asset sales, and other types of revenues. So the important thing here to look at, this is the traditional way that accountants show you the accounts. This is using the traditional T that accountants use, but you can use this as if you are more inclined to mathematician, you can actually use these expressions here. So if you give a number to each one of these items, and you can express everything as an accounting identity. You know, to differentiate between an identity and an equation, we use this sign rather than the equal sign here. And here you have all these equations that, or identities that you can use, and these identities are useful to. I think I need to. Okay, for you to build all the other, a number of other statements that can be also useful to understand how the company operates. For instance, traditionally, people used to look a lot of sources and use of funds. So you basically would see which were the sources of fund, and you have here the sources of fund, like, you know, net income plus increases in debt and so on. And the same with the uses, and you'd get the difference between the source and the use would give you a measure of the so-called statement of funds. This actually got a bit out of fashion. Nowadays, people don't use this anymore, but you know, nothing wrong if you want to use it. Then we have here also a new measure that we introduce ourselves, that we call balance sheet efficiency, and it can also be derived from these identities. And then the one that is mostly widely quoted these days, which is so-called cash flow, and it is very popular now to refer to the cash flow as being important. But you have several types of cash flow that you can calculate. You have them. All of them are listed here. You can an important measure is so-called free cash flow, and you can see the free cash flow that is owned by the shareholders, or the one that is used for from the point of view of the company. And then you have also measure of cash flow that can be used for valuation, which is usually used for valuations. So you have all these identities and a few equations here in the middle. If maybe I think it's on, should be on identities. So you can actually find this if you want to have more detail. So the basic thing is that you have the basic information. You companies transfer them into the income statement and balance sheet, and from that you can derive all the others, or they usually now present also the cash flow statement, which is more detailed that you could get from just income statement and the balance sheet. Or they also now show, I think I have it here on page 2, what's called the statement of capital changes. Again, a new table showing how the capital has changed. Again, also some companies publish a statement of comprehensive income, which is a presentation of the income statement, which also takes into account so-called non-controlling interests, which are not, of course, don't belong to the shareholders. So you have all these oil changes. There's also an important fact about accounting that one needs to take into account, is that nowadays accounting is not a very entirely reliable source of intelligence. And the reason is that in the old days, the 19th century before, basically accounting was used to be called bookkeeping. And bookkeeping would only register the cash transactions, so everything. And that is, of course, a very primitive way of doing accounting, because changes in value and lots of non-cash transactions also affect the value of a company and cannot be entirely disregarded. But when we decide, or when accountants decide to include valuations and non-cash transactions and also take into account accruals and so on, when they introduced that, they introduced a lot of uncertainty about the accounts, so a lot of possibilities to manipulate the accounts. So in the past, really, you could either commit fraud, let's say by cooking the books, which used to happen and still happens, of course, but that is straightforward fraud. But nowadays you can also embellish the books by playing with these accounting rules about non-cash transactions, about accruals and deferrals and so on. And nowadays you basically also sometimes need to rely on what's called checking for creative accounting. And this there's something that you also have to bear in account. So very often it's not really possible for a single investor to go straight to the accounts published by the company, but it's probably better to go through accounts that were standardized, which will also allow you, and this is very, very important, which will allow you to make comparisons between companies, which sometimes is an alternative to actually going through the accounts and trying to identify all the possible occurrences of creative accounting, so that the accounts do not really reflect the value of the company. So there is all this, but of course, comparing, as I said to you, comparing the accounts is a very important issue, and we actually have here a methodology that we introduced some time ago, which is in, let me see where I have it, page 7 of our presentation here. Okay, You see, if you go to our platform, you see something like this. And what we have here, these are some bars. You say, well, and this is actually a presentation of the balance sheet and income statement. Here on the left, you have the balance sheet. On the right, you have the income statement. The only difference is that these bars are calculated on what's called same size accounts. Basically, instead of using the actual values, the millions and thousands and so on, we calculate them as in relation to a fixed variable. And for instance, in these numbers here, we have two types of values. We have, if you see, we have some values in percentage and some without the percentage sign. So that means that these numbers that we have here are actually based on comparing. In one case, we compare any of these items in the balance sheet and in the income statement. We compare them with with equity, and the other one we compare with revenue. So basically, we compare with equity and revenue, and this corresponds to a traditional measure of profitability, two traditional measures of profitability. The first one, return on equity, it's very often used. Return on equity measures the profits that the shareholders make in relation to what in relation to their capital in the company. While the other one, which was more traditional, is a profit. It's a profit margin, which is again the net income divided by the total revenue and gains, and gives us a traditional measure of a profit rate, which are very easy concepts but if we want to change, this chart, we can also click here and have everything expressed as fund as a percentage of fund, or expressed as a percentage of assets. For instance, instead of using return on equity, we can use return on assets, and then we get the difference. And the interesting thing here in this chart really is that we have total revenue as the link between the balance sheet and the income statement. So here we need, on the left side on the balance sheet, we have what we need to generate a given amount of revenue. And so it's important to see, for instance, how much equity we need to generate, or how much revenue we generate with the unity of equity, for instance, or the accumulated equity that you have, or debt, or the so-called balance sheet efficiency. And likewise, we have the cost of goods, the cost of revenue, and then the administration and all the other costs, the depreciation, interest, and so on. And of course, the difference then, the final is, the difference is the return on equity, or the profit rate. You'll see that we'll have here as positive numbers. Here we have here is negative numbers, because this is a number that is subtracted, and this is the one that is added, but the value is exactly the same. Just change the sign, whether it is on the balance sheet side, or it is in the income statement side. So if it comes here as a negative, that means that is positive, that the company is profitable, and should be positive here. And if it's the company is running a loss, it will come positive, and here it will be negative a negative impact on the balance sheet. So these are the kind of basic accounting ways of looking at the company. and give you a good insight about the quality of the company, because at the end of the day, because they are expressed in the same size, you can compare a big company like Apple with a very small company, or if you can compare a company in the US with a company in Germany or some other country, because they are in the same size, we are using the same size of measure, so you can compare different companies in different sizes or in different currencies using this the same approach. That's why this is a very useful tool. Okay, so this we call it waterfall analysis, and it's a measure that we think is a very good way of looking at the accounts, even for people who don't understand or know much or anything about accounting. So they can get a good understanding here. Now, of course, people don't use only accounting. They also compare various items in the accounts. And these items are usually expressed as a ratio. And the ratio, as you see, is a division of X, so the over Y. So if you put here X, you can put here whatever you want. Let's say you can put here the net income. And here you put here equity. Then you have a ratio, a return on equity ratio, which is very commonly used. But of course, you have to remember that a ratio is simply a division. There is nothing special about this. What do we need to make sure that you understand the ratio is that there must be some relationship between net income and equity, because if there is no relationship at all, I can put here, say, potatoes divided by bananas. I mean, there is no relationship between potatoes and bananas, so the ratio would be meaningless. But of course, I could also invert the ratio, so and write equity times divided by y, and this would be another different metric. And so we have to be sure that we understand what is in the numerator and what is in the denominator, and if there is any meaningful relationship between them. Otherwise, if you were going to use all the items in a balance sheet in the income statement, let's say 50 or 100 items, and used to relate them in a ratio, you would end up with thousands of ratios. I mean, and many of those ratios would be meaningless. They wouldn't have any meaning at all. It would be like having potatoes and bananas in our ratio. So we have to make sure that they are they really are related as a relation to it. And also we have to, when choosing the way we express them, we have to take into account some practical things, like if some of this item is negative. So if I have this like something like this, I may have some difficulty in expressing it. But let's say that I have both of them negative equity and negative income, then this would be positive, right? And so I could interpret this very, very easily. So we need to also take into account, when looking at specific ratios, how we can interpret them, and it's fundamental that we interpret them. And so that's something that we should be careful when dealing with ratios. And in our analysis, we have plenty of ratios, and some of those ratios in our due diligence reports and so on,